European Securities and Markets Authority, or ESMA, has implemented a range of measures intended to protect the retail clients trading leveraged products like CFDs. These 6 measures include leverage limits on the opening of a position by a retail client from 30 to 1 to 2 to 1, a margin closeout rule on a per-account basis at 50% of minimum required margin, negative balance protection on a per-account basis, a restriction of the incentives offered to trade CFDs, a standardized risk warning, including the percentage of losses on a CFD provider's retail investor accounts, prohibition on the marketing, distribution, or sale of binary options. So, who is protected under negative balance? Negative balance protection is implemented to protect retail traders from losing more than their initial investments. Can a retail broker get the same negative balance protection from their liquidity provider? As stated earlier, ESMA mandates that negative balance protection rule is designed to protect only the retail traders. Professional traders or brokers are treated differently. Let me explain it with an example. Let's assume a 100% STP retail broker holds $100,000 in an omnibus account with the liquidity provider. For example, 2 retail traders deposit $50,000 each to the retail broker. Let's say retail trader 1 goes 5 lots long USD CHF with an open price of 1.0178. Retail trader 2 also goes 5 lots short USD CHF with an open price of 1.0173, assuming both traders place the trade at the same time. Liquidity provider has no open position as the trades were netted and has an equity of $99744.7. Calculations are explained in the article. Swiss National Bank decided to remove the 3-year-old peg of their exchange rate, which resulted in unexpected volatility in the market. Due to the unexpected news, market reacted with a huge gap, which resulted in a margin call for retail trader 1 and left the trader with a negative balance of minus 32425. As per the new rule, retail trader 1 account should be reset to 0 and the broker must consume the loss of $32,425. Whereas retail trader 2 still has the open position and is in profit of $82,425, and therefore now broker has $132,425 liability to retail client 2. On one hand, liquidity provider account will not show much difference, as it was netted and currently has a balance equity of $97,702, with an open position of 5 lots short USD CHF. On the other hand, broker's total liability to both traders is $132,425, while only $94,702.6 could be covered by funds at liquidity provider. Thus, broker has a deficit of $34,722.4 that broker needs to cover from its own capital. This is likely the reason why regulators have also asked brokers with STP-only license to upgrade to market makers in order to be able to absorb such deficits that may arise due to extreme market volatility. The difference in the balance of retail trader and liquidity provider account could leave retail brokers with no options but to go out of business if they do not possess necessary capital to absorb such market shocks. The above example proves that a 100% STP liquidity provider cannot offer negative balance protection that will fully cover retail brokers from losses, as individual retail traders can go negative while omnibus account at the liquidity provider may not. If your liquidity provider does claim to offer negative protection down to the individual retail level, it is clear that provider is market making on the flow. Otherwise, provider would run into the same issue with their Tier 1 Prime Brokerage. If you are interested to learn whether or not your provider sends your trades to the interbank market or internalizes it, you may do so thanks to the new MiFID II rules. MiFID states that upon reasonable request from a client, investment firms shall provide its clients or potential clients with information about entities where the orders are transmitted or placed for execution in order to provide more clarity on the execution venue. Thank you for watching and happy trading. your advanced markets team.